Hey guys, thank you so much for joining the Think Realty podcast. I'm Eddie Wilson, founder of Think Realty, and it's my privilege to be the podcast host. I kicked Avi off. I was tired of seeing him. I decided I'd just do it myself. I'm just joking. We'll get Avi back someday. But we've got a great guest for you today, and we'll get to that in just a second. But I want to say a quick thank you to our podcast sponsor, which is Real Property Management. Real Property Management will put more money in your pocket versus take it out, as all good property managers will do. Can I tell you the secret to owning rental properties? I've got around 4,000 doors, and the secret is property management. Well, maybe finding good deals too, but Real Property Management can help you, and you can find out more about them at Real Property MGT. That's realpropertymgt.com. We've got Chris Ragland on the show. No stranger to the Think Realty universe.
Not at all.
Megaverse, whatever it is, multiverse. And so I'm glad you joined us.
Thanks for having me. I'm excited as always to be here. It's another Think Realty event, and yeah, it's just exciting. It's good to see familiar faces, but also the new faces.
Yeah.
People getting in the industry and they're like, is now a good time? And I'm like, it's always a good time.
Yeah.
Depends on what side of the deal you're on.
Yeah. Well, it might be. Yeah. I'll tell you in a month or two.
Right.
Yeah, very, very interesting. Yeah, cool. So the market's kind of crazy. Well, first of all, let's Chris is longtime. He's helped me on the APL side with legislation. He's helped me on Think Realty with legislation, investor, everything from real estate to private equity. You've kind of done it all, operations, led your own organization. You've just done a bunch of stuff all over the place. Is that enough of like context for them?
Probably so. I mean, look, I've been in real estate or real estate related, which means also finance, businesses for over 2 decades.
Wow.
I just thought about this the other day and I was like, wow, I've been doing this, since pre 9/11, and I was like, oh, that's over 20 years ago.
Yeah,
that's a long time. Yeah, that's a long time to have been in real estate and finance. And along the way, started different companies and everything from very big institutions to small startups and everything in between. It's been a really exciting career so far.
Awesome. Yeah, always crushing it. Always enjoy, running into you at a Delta Sky Lounge periodically. But anyways. I know. As soon as you posted that picture of Austin, Texas, I was like, I know that's in the Delta Sky Lounge. But
true.
It's so funny.
True story.
So let's jump into maybe the 1,000-pound gorilla that I've had a lot of people not really want to talk about, and I think it's because they don't feel like they have a depth of knowledge enough to dissect down what the issues are. The banking industry is in disarray, and we're also still raising interest rates, which I think is an interesting narrative, because if, my perspective is that Jerome Powell, the Federal Reserve, would be very delicate after we just saw a couple of banks fail. Not small banks, sizable banks, like big banks, fail, and knowing that panic in the American public, or even softening further, could cause more banking issues, right? And but yet we raise rates another 0.25%, steady as she goes. Just keep plowing ahead, just trying to keep knocking inflation down, And then Redfin comes out yesterday and says they believe that we'll be back down in the 6% range by the end of this year. And I'm like, man, what is going on? It's like all this like interesting, just undulation of the market. And so what's your take, number one, on the banking industry, number two, where the Fed's going, and how does that correlate?
Man, that's a lot, and there's a lot going on. So let me think about this. My take on the banking industry, we're starting to see some of the long-term effects that to be really honest with you, it goes back to the 2008 crisis. The new levers that were pulled at that time. And if you remember TARP, Troubled Asset Relief Program for banks, right? Where everybody but JP Morgan needed money. Right. And Jamie Dimon, he's really proud of that.
Yeah.
So
heard it lots of times.
He makes sure everybody knows. It's like a badge for him. But no, I think we invented some new stuff at that time. Quantitative easing, all these things. So what's happening now is we're seeing an unwinding of some of those tools and rapid inflation, which is happening because maybe of what happened during COVID.
Sure.
right? So we pumped a lot of money in the markets that was artificial. We basically just created new money, and when you create new money, it literally leads to inflation.
Yeah.
It's like a what was it? Morton Friedman, he talks about this incessantly. It's like this is how inflation occurs.
Right.
Consumers do not create inflation.
Right.
The government creates inflation.
Right. Sure.
So you've got different levers that we've never really used before. You've got a large existential crisis that was COVID that gave monetary policy an excuse to turn to rapid inflation, and now you're seeing the government try to respond. When you start to look at all of this stuff at the same time, it's put Jerome Powell in a difficult situation. He has the big lever, right? The big lever is just interest rate.
Right.
And the problem is when he increases rates, it's supposed to slow inflation. But also when they increase rates too fast, something else happens that probably a lot of people were not paying attention to. And that's looking at basically long-term investment bonds that banks traditionally use whenever they're trying to tie up their capital. Now the interesting thing is who's being affected right now. Start looking at the banks that are having trouble, right? Silicon Valley Bank or SVB Bank, whatever you want to call it. You look at Credit Suisse, Signature Bank, First Republic. These are all banks that locked up effectively. And you start going, why? And the answer really is in their balance sheet. When you look at their balance sheet, if you know what to look for, you go, oh, I see why. And so I think what's happening yet again is the regulators are going to say, oh, we can't allow banks to do that thing, and they're going to put new restrictions in place, which is causing all of the uncertainty in the marketplace right now by bankers. So what do bankers do, which tend to be conservative? They're pulling back on everything right now and saying, we're going to have to hold on because we're not really sure what's about to happen to us. So that's my short take on how we got where we are today. But I'd love to dive down any of those roads that you want to go down.
I mean, it's also fascinating to me because it's like, you're talking about the levers that are being pulled, right? And what's fascinating to me is like, I mean, most people, you ask them, what is the reason the Federal Reserve exists? They would say, well, to counter inflation or whatever, control inflation. And it might be deeper than that. It might be actually just to protect the American dollar, right? Like that might be the actual very bottom basement. Like this is like, they're just protecting the American dollar.
I 100% agree with you, by the way.
And so when I watch what they're doing, it's also opening some new doors and maybe some new levers that could be pulled. I like your take on that there might be new regulation. I mean, so we saw Dodd-Frank, then we saw the Dodd-Frank, I sat on the subcommittee that modified Dodd-Frank, which really, I was point number 3, which was what standards or what liability can a bank take on in their investment. Right. That would be the point that actually would have to get modified, right? In what you're talking about, which would be fascinating. But then also, like, there's this underlying like feeling about just change, and so like I've heard everything from this is going to bring in the new era of cryptocurrency or some sort of digital currency. I've heard that there's an intentionality to this because a recession would be good because all of the liquidity that's sitting on the sidelines is not getting yield, and we know in recessive activity that's where they're going to find yield. Like they're going to find deals and opportunity, and so it's just like this. I don't know. It just seems like muddy, right? Like it feels like there's way too many dials and levers being turned all at the same time, but there's these like commonalities between all of it, And so
I do see a lot of that, but I want to also stress that some people are self-affected,
right?
Meaning like they truly should not have been impacted, but they're choosing to be.
Sure.
A good example might be community banks. I'm a big fan of community banks, big advocate. I do a lot of banking with community banks. Most community banks are not affected by what's going on, other than rates just rising, and of course that changing a little bit of what they borrow at the window rate, right? So, but they're still being super ultra conservative suddenly, even though nothing has changed for them. And it's an anticipation of the change, right? Now that's not healthy. That's actually harming customer relationships, deal flow, what should be happening. I get it if the bank locks up. And by the way, I do have a company right now. Here we are on today's day, what is it? 10 maybe since it happened, right? Since Silicon Valley kind of locked up and the feds walked in. And so we're over a week out. And one of my companies still has capital that's locked up in a bank. I won't say the bank's name, but that is still going on. But the community banks, they're not affected. They're not locked up. The other thing that's happening, though, that I think is, we're talking about these other levels and unintended consequences. And to believe it or not, Janet Yellen got put on the spot for this just recently. But we're talking about massive amounts of capital leaving community banking and going to the big banks because they're basically saying, look, the big banks are too big to fail. They're going to get a bailout. Maybe not my community bank. So how about all my deposits need to be under $250,000?
They're calling it fear flight. It's like,
and it's very real. I have shepherded, I'm not kidding you, maybe 24 new account creations at various community banks because I've had investors and business partners basically insist that we move capital and disperse it. And that is not a conspiracy theory. There is real data. You could look at it and see it happening right now.
Well, I think the average guy that's running a business, like I called my CFO and I said, we use a community bank for all of our local banking, and so my lines of credit, all that type of stuff for my private equity side, and then I've got my JP Morgan relationship and stuff like that, the private banking and all the stuff that I get with them. And I literally said, what's our split between cash that sits in the big bank versus cash that sits in the little banks? And, are we diversified? And, and then I literally made, a couple of just large moves to just make sure that I was spread out, that I had access to capital. I wasn't so worried about preservation because I think it all is a balance sheet issue. A run on a bank is fear, but fear is typically driven by something, And so we did spread some stuff out, but it wasn't like, I'm going to put it all into JP Morgan, just because I think this small community bank is the one that's going to fail. But so I agree with you, but it is fascinating because there are levers that are, let me give you this scenario. So interest rates rise again. And let's say steady as she goes, and she literally, they raise rates again, like this summer or something. And it causes consumer panic or consumer frustration or consumer pullback. And the small banks are so reliant on lending to consumers. Like that's typically a third of their capital source, and they're a third of their revenue, and depending on what their style is. But now they've lost it, so it's going to affect how liquid the bank is. It's going to affect their balance sheet. It's going to affect how they look on paper. Is this another domino that's going to fall?
It really could be. I don't have the data yet, but I'll tell you what I'm seeing on the front lines. I'm seeing a lot of the end buyers in some of these real estate projects that didn't lock their rates cancel their contracts. So you're seeing a market shift right now, but I am seeing a lot of those deals just get scooped up by the next guy.
Right.
So let me tell you this, for every deal that I see fall apart because someone got beaten up by the rates, I am seeing a cash buyer jump on the scene and gobble it up quickly. One of my larger investors, it's an interesting guy. He's one of the few people I know that has 4 bona fide passports from 4 different countries. Fascinating story. I talked to him today while I was driving here, and he's a buyer suddenly, an aggressive buyer, and he's all cash, and the shark fin has come out, and he is hunting for deal flow right now. So I do think it's a little early to see if there's another domino that's happening right now, but I think there's a significant amount of disruption in the buying pool. So yes, to the people who think, the conspiracy theorists who think, well, this is how we're getting all the cash back in the market, maybe, but it's going into a lot of tangible assets.
Right.
To the crypto advocacy guys, I'm still not a fan. So I get it. But all the way back to what you said, the Fed was created to protect the dollar, for me, without question. But I don't envy, Fed Chair Powell, because think about what he's got. He's like, if I pull the lever this way, I harm consumers. If I pull the lever this way, I harm the banks. What do I do? I think if we hadn't had this crisis, it would have been another 50 points. And then maybe they would have started looking out to next year, because if you read the notes, that's what they were talking about. The fact that they went down to 1/4 of a point, I'm not a crystal ball guy very often, but I think that we're going to hold steady by the end of the third quarter. It's going to be super fast. And I think that's a kind of maybe a nod to those that are thinking that the 30-year rates are going to start to fall rapidly. If they see this and it consistently starts to take off, they're going to look at that 30-year T-bill and go or the 10-year T-bill and say, this is significant change in the markets. And there are still dominoes to fall. We have to see what inflation does in reaction to this new increase. And it'll take a little while for that to kind of show itself. But if inflation does, to some degree, get within their window of desired amounts, it's going to be interesting. And then if we see that 30-year begin to fall,
we still have economic pressures that are, not enough supply. It's like we're 6.5 million homes underbuilt, and we need 1.8 million built just to keep up with a population growth. Last year we only built like 105 or 1.5 million, and this year they're saying that if we stay on pace with building permits, we're only going to build somewhere between 1.2 and 1.3. Our deficit is growing, and it's like, so is it a frenzy that comes on the backside of this? Like, it's super fascinating because I don't. It's like there's way too many dials, way too many moving parts, and so trying to dissect down which ones have the most impact or the most pressure is difficult.
It's very difficult when you think about the different dials, and then I think it's just as difficult to look at the outcomes. Who is going to be affected and who is going to take advantage of the situation?
Yeah.
I do think that there's a possibility you see more of a separation of kind of a have and have not.
Yeah.
I think those with money take advantage of the situation, and those without it further get depressed. And that's depending on who you are, that's a depressing thought. You know. So I think the outcomes are going to be fascinating as well over the next few years.
And it could look like European economics, right? Like where essentially it's the separation of the higher class and the lower class, and there is no middle class, and 50% of all real estate is owned by institutions. We could have more of a European economics, outlook.
That's very real. That's a very real possibility for the future of the United States.
Yeah, for sure. And Lawrence Yun, the chief economist for NAR, and I kind of took him on a little bit on LinkedIn because he came out strongly against the build to rent communities and institutions creating it. And he was like, you're creating this chasm, And for me, it's like, I don't feel like we should run from things. I think we should run to things. It's not my style. I feel like you lose momentum when you begin to avoid things or run from things. I feel like energy shifts, momentum begins to eat you. Like, it's just like, I feel like I have to pursue, never run from, And so like, I look at these situations and I go, no, we need policy. We need opportunities to, like, if you want more homes, incentivize the builders. If you want more buyers, incentivize the buyers. Like, create programs that get you what you want. Like, don't start limiting all of this other activity that's still beneficial. Like, we still have just as high a rent demand as we do purchase demand. We still have just as many, housing. We have such a housing deficit even on the rental side. And so it's like, so you're going to stop all of that, and then you're going to create the adverse effect. It's just going to drive more demand on this side, which is going to drive appreciation. It's like. And it's super fascinating. I mean, obviously, what I love is when people, like I was reading on my phone between podcasts today, people just tearing down the Fed, acting as if these people are ignorant. Like, these people have access to data that we could only dream of. And these are brilliant people. They're not slouches. They understand the economics of our nation far greater than most people ever could comprehend. And they're dealing with these minute dials that are having these effects. And like you said, it looks like this big giant lever, but it's like they're looking at massive amounts of data trying to look through this. And so, I mean, your outlook, are you bearish, bullish? Do you feel like, because I'm still charging in right now. Like, I still think that economics still play in my favor when it comes to purchasing real estate. I'm not super happy with the protection that I have of my cash sitting in banks, both for inflation and for safety of banks. I mean, we're doing a bunch of things to offset that. Hard assets, you go back to the Great Depression, the people that ended up coming out of the Great Depression wealthy were the ones that sat on hard assets. Not stocks, bonds, mutual funds, it's like, and so when I look at this, I'm still kind of bullish, like I'm still buying, I'm still building, where are you at?
Yeah, so I will, in a weird way, always be bullish.
Yeah.
As you know, I work with a lot of family offices, so the horizon for myself and for them is much longer.
Right.
So it's kind of like, what do you think that property will be worth?
It's like a generational horizon.
Yeah, it's like, what's it worth in
100
100 years?
Right.
It's like, is it a good deal for today? Of course it is.
Yeah.
Could I put my money somewhere else that would have beat that return? Maybe, but would it have a hard asset backing it?
Yeah.
That, is really difficult to lose a substantial amount of its value? Mm-hmm. That's the part, It's the best combination between something relatively safe that also appreciates over time and provides you an opportunity to earn cash flow.
Yeah.
Like, show me the things that have all three of those that also last forever and can be intergenerational.
Right.
There's just not many assets that are like that.
Yeah.
But more on a realistic level, if you're like just getting into real estate, or maybe this is your first Think Realty conference, is now a good time to get in. I think there's always good deals. You just have to know how to underwrite deals and find the good ones.
Yeah.
Even when things are just going crazy, I don't advocate being sloppy and buying just any deal.
Right.
I always want to see the fundamentals underneath.
Yeah.
I still think it's a great time to be buying, and I am a buyer, so I'm in.
Yeah, and I think that to second that, it's like, and if you are a novice, like you're not just going to stub your toe in this market. It's going to be painful. It's best to attach to those that understand the economics of what's going on, that have enough liquidity to weather storms, that understand how to underwrite deals. I've told so many people that have come to conferences recently when they're like, is this a fix and flip market? Is this a buy and hold market? I'm like, this is probably, if you're accredited, maybe you should just get in as syndicate and to somebody that actually has written deals for 10, 15, 20 years and watch how the economics of this play out, because it's market by market specific, it's asset by asset specific, and it is difficult.
I get that question a lot too, and just basically tell me, how do I get into that industry, right?
Yeah.
Whether it's real estate, private equity, whatever. And my answer is there's two answers. If you want to work, like really work, then like literally go work for someone for a little while before you go do your own deal. If you want to invest and you want to learn, then get in someone's fund or do a syndicated deal or do a JV or whatever that might look like. But pair up with somebody
that'll pull back the curtains and show you how it works.
And maybe mentor you. That's great too. You can be an investor and learning at the same time all day.
Yeah, that's awesome. Cool. Well, we're out of time. That was super
Always
fast
fun.
and really, really good. Yeah. How do they connect with you? You like pretty active on social?
I am active on social. You can always find me at Chris Ragland on Twitter. You can find me at chrisragland.com.
Okay, very cool. If you want to pick a fight with him on Twitter, just pick a couple topics he doesn't like, give him a hard time. It'll be fun. Thank you guys so much for watching and taking some time out of your day to be a part of our world and allowing us to be a part of yours. And thank you to Real Property Management for being our podcast sponsor again today. Go to Real Property MGT, show them some support. Let them give you a quote on your properties and see if maybe they would solve some of your property management issues. I highly recommend them. And if you haven't bought your Tampa tickets, one of the hottest markets in real estate today in the United States is Tampa. And we've got an event there July 13th and 14th. And you can use the code podcast and it'll give you a buy one, get one free on tickets. We'd love for you to come, grab your spouse, your neighbor, business partner, or like me, I try to get my kids involved, bring a son or a daughter to the event. And let's have conversations about real estate. You can find capital there, you can find deals there, you can find investment strategy there. And you'll find all of our resident experts there as well. So we hope to see you in Tampa. Go on to thinkrealty.com, buy a ticket, and we'll see you there.